In week 6 now, we look at merchandise companies. Now, merchandise companies buy in goods and resells them. To this point, we've only talked about business transactions and financial statements for service companies, companies that provide a service. So now, our objectives here, number 1, we should know how to record journal entries for sales transaction. 2, we're going to introduce the cost of goods sold section and distinguish between perpetual and periodic inventory procedures. Then we're going to look at the journal entries for purchase transactions. We're going to introduce freight terms and how we record transportation costs. We're going to look at how we come up with a cost of goods sold, and finally, how we prepare a classified income statement. To begin with, we look at the difference between a service company and a merchandise company's income statement. Now, a service company earns its revenue and matches the expenses it incurs against that revenue to come up with its net income. A merchandise company, though, earns its revenue by making sales of merchandise. Now, they've purchased this merchandise, so one of the major expenses for a merchandise company is the cost of goods sold. And so we match the cost of goods sold against the sales revenue, and we introduce a new term which is called gross profit or gross margin. And from gross margin then we deduct operating expenses to come up with the net income. So you see, an income statement for a merchandise company has 3 main divisions. 1, the sales revenue area. 2, the cost of goods sold. And 3, expenses. We first looked at the sales revenue section, and we're going to learn how to record sales revenues in this case. And we're also going to introduce sales discounts and sales returns and allowances. So therefore, when the company makes sales, we record that in gross sales, but sometimes a customer will take a discount and we reduce the gross sales by the sales discount, and sometimes a customer will return or ask for an allowance because of defective goods. So we also subtract that to come up with what is called net sales. Before we get to the sales transaction, we want to look at a sales invoice. Now, we are Bryan Wholesale Company, and we are selling to Bear Company. Their customer number order 218. Our invoice number is this. Our date December 19th. Now, we shipped December 19th, and the terms of the sale here are net 30, which we'll discuss later, and FOB destination, which we will also discuss later. Now, the quantity of items, we shipped them 200 of these True Tone stereo radio model so-and-so, $100 each, so the total invoice price is $20,000. Now we use the invoice as a source document to record this transaction. And the invoice states that we have sold and therefore passed legal title of the goods to the buyer, and that the seller has established the selling price, which is on the invoice. The seller has completed its obligation because it has delivered the product to the buyer. The seller exchanged the goods for other assets, such as either cash or accounts receivable, and the seller can determine what the cost of goods sold or the other costs incurred in selling it. Now, each time a company makes a sale, a merchandise company that is, the company earns revenue. This revenue, though, is called sales. Now, to record sales of merchandise, let's assume that the sale, first of all, was made for cash. Well, we simply debit cash $20,000 and credit revenue. Remember, we credit revenue always. Only this time the account is called sales. So we credit sales $20,000. It's a revenue account. If the sale is on credit, then what we do is debit accounts receivable and credit sales. Now, for a merchandise company, sales is the same as revenue account for a service company. But unlike a service company, when a company provided a service, that service couldn't be returned or there was no discount on the service. But for a merchandise company, the transactions are a little different. When we sell goods on account to our customer, we have what are called terms of the invoice, terms of payment. And here you'll see, as we said before, maybe 210N30. That's one of the terms of the sale. That means the buyer, who pays within 10 days following the invoice date, may deduct a 2% of the invoice price. If payment is not made within the discount period, the entire invoice price is due in 30 days from the invoice date. It's called a cash discount, and it is a reduction in the invoice price. So let's assume now on July 12th, I sold to a customer on account, debit, accounts receivable, credit, sales, straightforward. The terms are 210 net 30. On the 21st, which is 9 days later, the customer pays me. Well, because he pays me, he cancels his accounts receivable. But he doesn't pay me the $2,000 he owes me in accounts receivable. He takes a 2% discount. So here's a new account called sales discount. And therefore my journal entry is debit cash $1,960 because that's what I received, and debit sales discount. And that's how we record the discount. Now this sales discount is a debit balance account, but it's a debit because it's contra revenue to sales. Keep in mind that sales would be a credit balance account. Well, this one, discount, sales discount, is not a debit balance account because it's an asset or an expense. It's a debit balance account because it's called a contra, opposite the revenue. Because revenue has a credit balance, a contra revenue account will have a debit balance, and we will deduct that contra revenue from gross sales when we do the income statement. Now, in addition to sales discounts, a customer may return the goods because they're not satisfied with them, or they may keep the goods but want some kind of an allowance, a discount on what the invoice price would be because the goods may be inferior or damaged or something along that line. Well, again, sales returns and allowance is a contra revenue account. And the journal entry would then be debit sales returns allowance 300 and reduce what the customer owes me, so credit accounts receivable 300. Finally, we put it all together, and this is a partial income statement for Hanlon Retail Food Store, let's say. Now the revenue section starts off with gross sales, $282,000. We subtract sales discounts, sales returns and allowances, a total of $20,000, and therefore we show net sales of $262,000. So that's how we record sales transactions. And now you have some new terms, sales discounts and sales returns and allowances. And both these two new accounts are called contra revenue accounts. Next, we look at the cost of goods sold section.